Welcome back to the Mortgage Loan Originator Exam Prep Podcast. We're moving into episode 3, where we'll cover one of the most critical sections of the exam, the mortgage loan origination process. In this episode, we'll break down the entire process of originating a mortgage loan, from completing the loan application, Form 1003, to calculating key borrower ratios, like debt to income, DTI, and loan to value, LTV. We'll also discuss credit report analysis, the difference between pre-qualification and pre-approval, and more. This is a big episode, packed with important details and exam tips to help you feel confident and prepared. Let's get started. Part 1, the loan application process, Form 1003. Let's start with the loan application process, which centers around Form 1003, also known as the Uniform Residential Loan Application, URLA. This is the standard form that lenders use to collect borrower information for a mortgage loan. What's on Form 1003? Form 1003 contains 6 essential sections of information that lenders need to evaluate a borrower's ability to repay the loan. 1. Borrower's information: name, address, social security number, date of birth, and employment history. 2. Property information: details about the property being purchased or refinanced, including the address and whether it will be the borrower's primary residence, second home, or investment property. 3. Income and assets: the borrower's income sources, salary, bonuses, retirement income, etc., and assets, bank accounts, retirement funds, investments. 4. Liabilities: the borrower's debts, including credit cards, student loans, car loans, and other monthly obligations. 5. Loan details: the type of loan the borrower is applying for, such as fixed rate, ARM, FHA, V, etc. 6. Declarations: this section asks about the borrower's financial history, including questions about bankruptcies, judgments, and foreclosures. Why is Form 1003 important? Form 1003 is the starting point of the mortgage process. It allows lenders to gather the information they need to determine whether the borrower qualifies for a loan. It also helps the lender calculate key borrower ratios, like debt to income, and loan to value, LTV, 2 of the most important metrics in the loan approval process. Test tip: the 6 pieces of a completed loan application. The exam may ask about the 6 pieces of information required for a loan application to be considered complete. Use the acronym ALIENS to remember these 6 pieces. 1. A equals address of the property being financed. 2. L equals loan amount requested. 3. I equals income of the borrower. 4. E estimated value of the property. 5 equals name of the borrower. 6. ESHT social security number to pull credit. Once a lender has all 6 pieces of information, the loan application is considered complete, and the lender must issue a loan estimate, LE, within 3 business days. Up next, calculating borrower ratios. We'll cover DTI and LTV, 2 key calculations you need to know for the exam. When a borrower submits their loan application, one of the first things the lender will do is calculate the borrower's debt-to-income, DTI ratio, and loan-to-value, LTV ratio. These ratios are critical metrics that lenders use to evaluate the borrower's ability to repay the loan. Let's break each one down. Debt-to-income ratio. The DTI ratio compares a borrower's monthly debt obligations to their gross monthly income. It's used to determine whether the borrower can afford the loan payments. There are 2 types of DTI ratios you need to know for the exam. 1. Front-end DTI, housing ratio. This ratio compares the borrower's monthly housing expenses, including principal, interest, taxes, and insurance, also known as PITI, to their gross monthly income. Formula: front-end DTI, our gross monthly income. 2. Back-end DTI, total DTI. This ratio compares the borrower's total monthly debt obligations, including PD, credit card payments, car loans, student loans, etc., to their gross monthly income. Formula: back-end DTI equals total monthly debt re gross monthly income. Key DTI limits to remember. For conventional loans, front-end DTI should be no more than 28%. Back-end DTI should be no more than 36%. For FHA loans, front-end DTI can go up to 31%. Back-end DTI can go up to 43%. Some loan programs may allow higher DTI ratios if the borrower has compensating factors like a high credit score or large cash reserves. Example of a DTI calculation. Let's say a borrower earns $6,000 per month and has the following monthly debts. Mortgage payment, $1,500. Car loan payment, $300 credit card payments. Step 1, calculate the front-end DTI housing ratio. PD equals 1,500, gross monthly income, front-end DTI equals $1,500, but a $6,000 equals 25 cents. Step 2, calculate the back-end DTI, total monthly debt equals $1,500 plus $300 plus $200. Gross monthly income equals $6,000. Back-end DTI, $2,000 or $6,000. 33 loan-to-value LTV ratio. The loan-to-value LTV ratio compares the loan amount to the value of the property. It's used to assess the risk of the loan. Formula for LTV. LTV equals loan amount y property value. Example, a borrower is purchasing a home valued at $300,000 and is applying for a loan of $240,000. LTV equals $240,000 over $300,000 equals 80 cents. In this case, the borrower has an 80% LTV ratio and is putting 20% down. Why is LTV important? Lenders use the LTV ratio to determine whether the borrower needs to pay private mortgage insurance, PMI, for conventional loans. Borrowers with an LTV higher than 80% are typically required to pay PMI. A lower LTV indicates less risk to the lender, since the borrower has more equity in the property. Test tip: be prepared to calculate both DTI and LTV ratios on the exam. You'll need to know the formulas as well as how to interpret the results to determine whether a borrower qualifies for a loan. Coming up next, credit report analysis and pre-qualification versus pre-approval. When evaluating a borrower's ability to repay a loan, lenders will carefully review the borrower's credit report. The credit report is essentially a snapshot of the borrower's financial behavior, including their payment history, outstanding debts, and credit inquiries. Let's break down what you'll find in a credit report, what lenders are looking for, and how it can impact a borrower's loan eligibility. What's included in a credit report? A credit report includes 4 main sections. 1. Personal information: the borrower's name, address, social security number, date of birth, and employment history. 2. Credit accounts: a list of the borrower's open and closed accounts, like credit cards, auto loans, student loans, and mortgages. Each account shows the account balance, the credit limit, and the borrower's payment history, whether they've been making payments on time or if there have been any late payments. 3. Public records. This section includes legal actions that could impact the borrower's creditworthiness, like bankruptcies, foreclosures, judgments, and tax liens. 4. Credit inquiries. This shows who has requested the borrower's credit report. Lenders look at hard inquiries, which happen when someone applies for new credit, and soft inquiries, which occur when a person checks their own credit or when a lender does a pre-qualification check. Hard inquiries can affect the borrower's credit score, while soft inquiries do not. Understanding credit scores. Most lenders use the FICO score to assess a borrower's credit risk. The FICO score ranges from 300 to 850. Here's a breakdown of credit score categories and what they mean for the borrower's loan eligibility. A score of 750 or higher is considered excellent. Borrowers in this range typically qualify for the best interest rates and loan terms. A score between 700 and 749 is considered good, and borrowers will likely get favorable terms. A score between 650 and 699 is considered fair. Borrowers in this range may still qualify for loans, but the interest rates might be higher. Scores below 650 are generally considered poor, and borrowers may struggle to qualify for certain loan programs. The higher the credit score, the lower the risk to the lender, and the better the terms the borrower is likely to receive. What lenders look for in a credit report. When reviewing a credit report, lenders focus on 4 key factors. 1. Payment history. Lenders want to see that the borrower has a history of making on-time payments. Late payments or missed payments can lower the borrower's credit score and signal that they may be a riskier borrower. 2. Outstanding debt. Lenders look at the borrower's total outstanding debt to determine whether their debt load is manageable based on their income. 3. Credit utilization ratio. This is the percentage of the borrower's available credit that they're currently using. A high utilization ratio, meaning the borrower is using most of their available credit, can be a red flag to lenders, suggesting the borrower may be overextended. 4. Public records. Lenders will check for negative public records, such as bankruptcies, foreclosures, and tax liens, which can disqualify a borrower from certain loans. Test tip. You may be asked to identify red flags in a borrower's credit report, such as high utilization ratios, late payments, or public records like bankruptcies. You should also know how these red flags impact the borrower's loan eligibility. Part 4. Pre-qualification versus pre-approval. Let's move on to the difference between pre-qualification and pre-approval, 2 steps in the loan origination process that sound similar but have very different meanings. What is pre-qualification? Pre-qualification is an informal estimate that gives the borrower an idea of how much they might be able to borrow based on basic information they provide to the lender. Think of pre-qualification as the starting point for borrowers. It's a quick way for them to figure out what price range they should be looking at when house hunting. Here's what you need to know about pre-qualification. No credit check is required. It's based on self-reported income and assets from the borrower. It's not a guarantee of loan approval. Because there's no verification of the borrower's financial information, a pre-qualification is less reliable than a pre-approval. What is pre-approval? Pre-approval is a more formal process in which the lender 1. Pulls the borrower's credit report, 2. Verifies the borrower's income, assets, and employment, 3. Issues a pre-approval letter stating the maximum loan amount the borrower qualifies for, along with any conditions for final approval. A pre-approval letter shows real estate agents and sellers that the borrower is serious about buying a home and has already been vetted by a lender. Key differences between pre-qualification and pre-approval. Let me break this down for you in a way that's easy to remember. Pre-qualification is informal. It's based on self-reported information, and it doesn't involve a credit check. Pre-approval is formal. It requires the lender to verify the borrower's financial information and pull their credit report. Think of pre-qualification as a rough estimate, while pre-approval is a conditional loan offer from the lender. Real-world example for clarity. Let's say a borrower named Sarah is looking to buy a home. Step 1. Sarah starts with a pre-qualification. She tells the lender her income, her assets, and her debts. Based on this information, the lender estimates that she might qualify for a $300,000 loan. Step 2. When Sarah finds a home she wants to buy, she gets pre-approved for a $280,000 loan. The lender verifies her income, assets, and credit score and issues a pre-approval letter, which she can show to the seller. Test tip. Be prepared to answer questions about the differences between pre-qualification and pre-approval. The exam may ask you to identify which step involves a credit check or to determine which step is required before making an offer on a home. Coming up next, completing the loan process and the role of underwriting. Once the borrower submits their loan application, it's time for processing, underwriting, and appraisal, all leading to the Clear to Close CTC. Let's break down each of these steps. Step 1. Processing the loan application. The loan processor is responsible for gathering and verifying the borrower's income, assets, employment, and credit history. This includes pay stubs to verify the borrower's income, bank statements to confirm their assets, tax returns for self-employed borrowers, employment verification, credit reports to check their credit history. Think of the loan processor as the person who ensures everything is in order before passing the file to the underwriter. Step 2, the role of underwriting. The underwriter plays a crucial role in the loan approval process. Their job is to determine whether the borrower meets the lender's guidelines and can repay the loan. The underwriter looks at 3 key areas. 1, creditworthiness. They assess the borrower's credit score and payment history to determine how risky the borrower is. 2, capacity to repay. This involves calculating the borrower's DTI ratio to make sure they can afford the monthly payments. 3, collateral. The underwriter evaluates the property to ensure it's worth at least as much as the loan amount. Common underwriting conditions. The underwriter typically issues a conditional loan approval. This means the borrower is approved for the loan, but they must satisfy certain conditions before the loan can close. Common underwriting conditions include providing updated pay stubs, resolving credit issues, like paying off a collection account, verifying employment one more time before closing. Once these conditions are met, the underwriter issues the Clear to Close CTC. Step 3, the appraisal process. An appraisal is required to ensure that the property's value is equal to or greater than the loan amount. The lender orders the appraisal through a third-party appraiser who visits the property, inspects it, and compares it to similar homes in the area. Step 4, Clear to Close, CTC. Once all conditions have been met and the appraisal is complete, the underwriter issues a Clear to Close, CTC. This is the final approval from the lender, meaning the loan is ready to move to closing. This wraps up Part 5 of Episode 3. Stick around. Next up is Part 6, Deep Dive, ANSA, and Other Unique Ownership Structures. Welcome back. Now let's dive into a unique property ownership structure you might see on the exam, the Alaska Native Claims Settlement Act, or ANSA. Passed in 1971, ANSA settled land claims for Alaska Natives by creating corporations that manage land and resources for Native shareholders. These corporations collectively own over 44 million acres of land in Alaska. Hash key facts about ANSA for the exam. Let's break down what you need to know about ANSA for the test. 1. ANSA corporations hold title to the land. 2. The land is owned collectively by the corporation and managed for the benefit of Native shareholders. 3. Land under ANSA cannot be sold or transferred like traditional real estate. This ownership structure is unique because the land is managed by the corporation, not by individual owners. What makes ANSA unique? Here's the key takeaway. If the exam mentions native land ownership, remember that ANSA land is held by corporations, not individuals. Because the land is owned collectively, mortgage lending on these properties may require special considerations. The lender may need to work with the corporation rather than an individual property owner. Other unique ownership structures you should know. Let's quickly review 2 more unique ownership structures that might appear on the exam. 1. Leasehold estates. In a leasehold estate, the borrower owns the home, but the land is leased from another entity, like a government agency or native corporation. These types of ownership are common in places like Hawaii, where large areas of land are owned by trusts or the government. 2. Tenancy in common. In tenancy in common, multiple people own separate interests in the property. Unlike joint tenancy, ownership shares don't have to be equal, and each owner can sell or transfer their interest independently. Test tip: the exam may ask about unique property ownership structures, like native land ownership or leasehold estates. Be prepared to recognize that these properties may come with special conditions for mortgage lending. Quick recap: ANSA and ownership structures. Here's a quick summary to help you remember the key points. 1. ANSA created corporations that manage land for Alaska Native shareholders. 2. These corporations hold title to the land, and the land cannot be sold or transferred like traditional real estate. 3. Leasehold estates involve owning a home but leasing the land. 4. Tenancy in common allows for separate ownership shares that don't have to be equal and can be transferred independently. Next up, quiz time. Let's test your knowledge from episode 3 with a quick quiz to reinforce what you've learned. Stick around. It's time to see how well you've locked in the key concepts from episode 3. I'll ask you a few challenging questions, then provide the answers along with explanations to make sure everything is crystal clear. Question 1. Which of the following best describes the role of an underwriter in the loan process? A. Verifying that the borrower's credit score is above 750. B. Ensuring that the borrower's debt is fully paid off before closing. C. Evaluating the borrower's ability to repay based on credit, capacity, and collateral. D. Collecting pay stubs and bank statements from the borrower. Answer C. Evaluating the borrower's ability to repay based on credit, capacity, and collateral. The underwriter's primary job is to evaluate the borrower's creditworthiness, capacity to repay, and the value of the collateral property. Collecting documents is the responsibility of the loan processor, not the underwriter. Question 2. Which ownership structure is unique to Alaska Native land claims? A. Leasehold estate. B. Fee simple. C. Alaska Native Claims Settlement Act, corporations. D. Joint tenancy. And C. Alaska Native Claims Settlement Act, corporations. The ANSA corporations hold title to Alaska Native lands and manage them for Native shareholders. The land cannot be sold or transferred like traditional real estate. Question 3. What does a clear-to-close CTC signify in the loan process? A. The appraisal has been ordered. B. The borrower has submitted their loan application. C. The loan is ready to move to closing. D. The borrower's debt-to-income ratio is below 36%. Answer C. The loan is ready to move to closing. A clear-to-close is the final approval from the underwriter, meaning all conditions have been met and the loan can proceed to closing. Question 4. Which statement is true about pre-qualification? A. It involves a hard credit check. B. It's a formal loan approval. C. It's based on self-reported information. It guarantees the borrower will be approved for a loan. Answer C. It's based on self-reported information. Pre-qualification is an informal estimate based on information provided by the borrower. It does not require a credit check. Question 5. Which of the following might be an underwriting condition? A. The borrower must refinance their car loan. B. The borrower must update their pay stubs. C. The borrower must provide a notarized letter from a neighbor. D. The borrower must buy a home warranty. Answer B. The borrower must update their pay stubs. Common underwriting conditions include updating income documentation, resolving credit issues, and providing proof of assets. Question 6. True or false? Land under the Alaska Native Claims Settlement Act can be sold like traditional real estate. Answer false. ANSA land is owned by Native corporations and cannot be sold or transferred like traditional private property. Instead, it's managed for the benefit of Native shareholders. Final wrap-up for Episode 3. Congratulations, you've completed Episode 3, Mortgage Loan Origination Activities. Let's do a quick recap. 1. The loan application process starts with Form TESO 3. 2. Lenders calculate debt-to-income DTI and loan-to-value LTV ratios to assess the borrower's ability to repay. 3. Credit report analysis helps lenders evaluate the borrower's payment history, outstanding debts, and credit score. 4. The difference between pre-qualification and pre-approval is key to understanding the loan process. 5. The loan processing, underwriting, and appraisal stages are critical in moving toward clear to close. 6. The Alaska Native Claims Settlement Act, ANSA, creates unique ownership structures for Alaska Native lands. Coming up next, Episode 4, Ethics in Mortgage Lending. In Episode 4, we'll cover Unfair, Deceptive, and Abusive Acts and Practices, UDAT, the role of the Consumer Financial Protection Bureau, CFPB, fair lending laws, and ethical responsibilities for MLOs. Stick around. You're doing great. Happy studying, and remember, you've got this.